it would take years and years of effort and investment for someone else to catch up with where we are in our expense ratio, our tech stack. And so look, you've got a company with these durable competitive advantages that are very significant. Having a 10 or 15 or 20 percentage point expense advantage in a commodity business like insurance, it's hard to believe it exists, but it does. But we have the opportunity to generate best-in-class returns and incrementally take market share for years to come. I think that's a compelling investment thesis for someone who's managing money and looking to put capital to work.
Hi, and welcome back to the Rock and Turner Investment Podcast. We're excited to have you join us for another episode filled with valuable insights and expert analysis to help shape all of your investment decisions.
Before we begin, please note the following legal disclaimer. The views and opinions shared in this podcast are intended for entertainment purposes only. Any references to regions, countries, sectors, stocks, securities, or other assets are for discussion purposes and should not be considered as recommendations to buy, sell, or pursue any specific investment strategy. This content does not constitute accounting, legal, tax, or investment advice and should not be relied upon as such. The material may include forward-looking statements, forecasts, or projections, which are inherently uncertain and not guarantees of future results. There is no assurance that any predictions or projections will materialize. All data referenced in this podcast has been sourced by us and is provided without warranties of any kind. The data may contain errors and should be independently verified before use. Neither we nor the data providers accept liability for any reliance placed on the information presented. Always conduct your own research, seek professional advice, and take responsibility for your investment decisions.
I'm James Emanuel, and today I have with me Michael Kehoe, the founder, chairman, and CEO of the insurance company Kinsale Capital Group. Welcome, Michael.
James, good to be with you today.
Thank you for giving me your time. I'm looking forward to this. So, Kinsale Capital was founded in the aftermath of the 2008 financial crisis, emerging as a focused, technology-driven E&S insurer built with a distinct operating philosophy. What I'm wondering is the timing of Kinsale's launch stands out. And so to what extent was the financial crisis a catalyst versus simply exposing a gap in the E&S market that you were looking to fill?
Yeah, the crisis just was, I guess, reverse serendipity. I quit my job at another specialty insurance company, and I think that was March 6th, 2008. And my recollection is that I kind of date the beginning of the financial crisis to those Bear Stearns hedge funds getting into trouble.
Yeah.
And I think that actually happened later in March 2008. So that was the unfolding of the crisis. Yeah, just bad timing on my part. But I think it does speak to the fact that there is always capital out there looking for an opportunity. And it's interesting looking back that even in the face of all the, the equity markets volatility and severe recession and what have you, we still had investors line up to, help capitalize Kinsale and launch the business, a year or so later.
Well, when you say that you quit your former job at another insurance company, I think you're being modest. You were the CEO of the other insurance company, right?
Well, I was the CEO and the president of the insurance company, and then my boss was the CEO of the holding company. So, it was a little bit of a different arrangement in that we had a unique holdco. We had two operating companies at the time. There was principally a work comp business, standard lines company, and then I was the head of the E&S operation.
Okay.
And so, I had a lot of autonomy to run the E&S company, but really my boss ran the holdco and made decisions around,
right,
other things and et cetera.
So your idea to launch Kinsale, and we're going to get into this shortly, which is a differentiated model to most of the other insurers operating in the market. Was this an idea that was hatched in your prior role, and was this a model that couldn't be deployed in your prior job? Or was it a frustration with the way that things were being managed at your prior employer that made you think, well, actually, we could do things better?
Yeah, I think it was a mix of a lot of considerations. My prior employer was a company called James River Group. James River started out as it was a de novo startup back in, 2002. We started to build it November of 2002, and I think we bound our first policy July 1, 2003. That company originally was focused exclusively on the E&S market. We've always been attracted to the margins available in that space and, some other things as well. But over time, the business plan evolved. We got into other lines of business, and so it was really, it was a chance for me to kind of retire for a year at a 1-year non-compete, and then kind of go back to our roots of focusing on the E&S space. And it was an opportunity to run my own company. Basically oversee the business strategy more definitively. James River, in a lot of ways, lost its way. They got into the work comp business. In hindsight, was very unattractive results. The Bermuda reinsurance platform, in hindsight, very unattractive results. And anyway, it was. I think it was time for me to move on, and I think in hindsight, that was probably a good move.
Interesting. Yeah, I just kind of made an observation. You kind of established James River just after the dot-com crash, and then you established Kinsale just after the Great Financial Crisis. There's a pattern emerging here.
Well, I helped. My boss, a guy named Adam Abram, he was really the catalyst that founded James River.
Yeah.
And then I kind of came on board to lead the E&S operation and really define that strategy. But anyway, that was a long time ago, and
fair enough. The rest is history. Okay, so you made a really early decision to centralize operations in Richmond, Virginia, rather than following what could be considered as an industry regional branch model, an industry standard. What does centralization enable you to do that others are missing?
Look, I think one perpetual challenge in leading any organization is around the concept of culture. Jack Welch, at the former GE kind of rock star CEO, he used to call it social software. And I think it's recognition that culture is so highly influential on human behavior. It's not just a rule book on a shelf. It's just the way we do things at any organization. And I think the more disaggregated your staffing model, the more offices you have in the more places, it just gets exponentially more difficult to drive a consistent business culture. Whereas, hey, it's still a challenge if you've got everybody in one office, but I think it's a lot easier. So I think there's that issue, and then there's the issue of efficiency. And unfortunately, insurance is a commodity business, especially when you sell to an SME type customer. There's an exaggerated emphasis on price to the exclusion of other considerations. And so I think it's really important to kind of, if you will, design and build the company always with an eye toward efficiency. Let's wring every expense we can out of the transaction. And then, the customer gets a little bit of that savings in the form of better insurance pricing. But, the stockholders get some of that benefit in the form of a better return. And of course, the employees, I think, get some of the benefit in the favor in terms of better economics as employees. So, it's not just the single location, but that's one, I think, important way for us to be a more efficient business. And, you talk about durable advantages, James. Imagine if you're a company with 10 or 20 or 30 or 50 locations around the United States. And if you decided one day, gosh, those guys at Kinsale are right on, we need to have one location. It's too late. If you've got 20 locations, people have their homes there, their spouses are working, their kids are in school. Sure. It's extremely difficult to go the other way. And so I think it was a good move in hindsight.
Yeah, and I think this goes hand in glove as well with your policy that everyone attends the office, right? You don't do any remote work.
Yeah, absolutely.
Okay, all right. We'll maybe come back to that later. So many insurers diversify once they reach scale. You entered the P&C, the property casualty market, on E&S lines, and you've kept that disciplined focus. Were there ever moments where expansion was seriously considered into other areas or maybe even international?
Yeah, I do think even though we've maintained our focus on the E&S market, we have expanded our product line every year, if you will, into adjacent markets within the E&S space, or added coverage enhancements, or what have you. So incremental expansion, that's part of our 17-year history. That will continue, all within the E&S space, in part because as a de novo startup, we're tiny. Even now, after 17 years, I don't know that we're tiny anymore, but we're almost $2 billion in written premium in 2025, but still a boutique insurance company compared to the big guys. And of course, the E&S market has grown quite a bit over this period of time as well. And so I think last year, if you include all the Lloyd's premium, E&S hit, I think it was $138.5 billion of written premium. Wow. And so our $2 billion, I think you identify, about 1.5%. We've got miles to go, I think, before we've exhausted our opportunity in E&S. I will say that if you kind of consider the near term, say the next 5 years or so, highly likely we'll continue to focus on E&S. As you go out longer term, I think it's almost inevitable we'll expand into the standard lines Still specialty related business, but there's just a lot of opportunity down the road, excess work comp, surety, crop, et cetera, where you almost have to be on licensed paper.
Yeah.
And so I think it's inevitable we'll get there, but I just don't think it'll be, the next couple of years.
Fair enough. Okay, that answers that question. Okay, I'd like to move on and focus on the competitive moat that Kinsale has, in particular, the focus on technology and efficiency. So Kinsale built its own in-house platform, and it took, by all accounts, 7 years to do so. But it enables you to materially quote insurance faster than your competitors, and it gives you tighter operational control than your peers who are reliant on legacy systems. So when we look at the platform today, should we think of it as a highly disciplined execution layer, or is there something genuinely proprietary embedded in the underwriting process?
I think that the best answer is it's both. I would look at it, in terms of a highly disciplined execution layer. I would say, look, you've got a system that was custom built for Kinsale. That customization is important. The reliability of the system, it's always evolving to accommodate new coverages we offer, new product lines. We have no legacy software. The CEO of AIG did an investor day about 8 or 10 months ago where he was talking about their commitment to technology and AI. And, as part of his presentation, he was acknowledging, I think it was 4,300 or 4,600 legacy applications.
Wow.
I suspect they go back, who knows, 20, 30, 40, 50 years?
Yeah.
That's an enormous challenge, not just for AIG, but for all insurance conglomerates that have been in business a long period of time. That's very common. And it's an enormous challenge to consolidate and retire all those legacy systems. And when you think about how those systems are built, most of those systems have embedded database where they accumulate the information with different naming conventions and different levels of completeness and organization. And Kinsale has none of that, right? We have one enterprise system. We do have a series of databases where we collect our data, but it's all the same organization, same level of completeness. The first policy we ever bound is in that database, every form on every policy, every data field on every form, on every policy, every claim. It's just an enormous step ahead, if you will, of an industry that's challenged by technology. But in general, I think of the technology as driving efficiency. It allows us to lower our expenses, accuracy. We're a very high volume SME focused company. We had a million new business submissions in 2025. We sent out 750,000 new business quotes. Between new business and renewals, we're binding hundreds of thousands of policies. I think it was 10,000 or so new claims were reported. So there's a lot of work underway, and technology can drive a high level of accuracy in your business process. It also allows us to provide much better customer service. Service is correlated to your hit ratio. The quicker you respond, the higher the probability of a bind order. And of course, data, right? You're collecting a tremendous amount of statistical information at the transaction level. It's collected in an organized format. So that's all critically important. But separate and apart from that, Kinsale has a long-term commitment to what we call taking a quantitative approach to the business, using data and analytics to make decisions in lieu of intuition, gut checks, old wives' tales, or whatever. And, the cliche in E&S is it's more art than science. And that speaks to the heterogeneity of the businesses we consider. We're the opposite of a big standard lines company that has an incredibly homogeneous and large pool of risk. We have smaller pools of heterogeneous risk. That being said, the same principle applies. And data can allow you to make better decisions, not only in how you segment and price risk, but how you make decisions overall in your business. And candidly, our service model is an example of that. One of our former colleagues now is the director of the company, Brian Haney. He did some analytics, I think it was over a decade ago, analyzing, across hundreds of thousands of submissions, why do we bind? Why do we not bind? And we're trying to learn what we could out of that data. And one insight that jumped out was the quicker you respond to the broker, the higher the probability of a bind order. That flew in the face of conventional wisdom. We had underwriters with 20 years of experience that said, that's nonsense. If you quote too quickly, the broker is going to shop your quote and you're not going to get a fair shake. Of course, if you quote too slowly, you're going to miss the deal, right? But there was this imaginary happy medium that people were targeting. And it's like, look, we're analyzing hundreds of thousands of transactions. The data is dispositive. There was no ambiguity whatsoever. Hey, quoting in 2 hours was like 1 percentage point higher hit ratio than 4 hours. And 4 hours was superior to a full day, or it kind of flatlined, I think, when you got to day 4. But, for a company like us that quotes such a high volume, a 1 or 2 percentage point increase in your hit ratio is tens or even hundreds of millions of dollars of premium.
Indeed.
Not because you're lowering your rate or you're increasing your commission or you're broadening the coverage. You're just giving your customer, in this case the broker, a little bit better experience, right? And that customer service can translate into incremental gains in productivity. So anyway, we shifted our entire business model based on that data. And again, that was a decade ago, right? But we have the opportunity to make decisions in our business. Maybe they're not all that profound, but many of them are quite material. And it starts with having good data, but it also starts with having a team. We call it our analytics and actuarial department. They're all genius level mathematicians, actuaries, data scientists, who spend a lot of time analyzing data, our own data we purchase, millions of dollars worth, data that we can scrape off of websites. And we use that to manage profitability, of course. But we're also constantly looking for ways to improve how we segment and price risk. And so that quantitative approach is the corollary to having a good tech stack. Tech to me is more about efficiency, accuracy, customer service data. But then on the back end, constantly working that data to get smarter about how you operate your business, price your risk, and the like.
Okay, so Kinsale works directly with wholesale brokers and keeps underwriting authority in-house, avoiding the traditional reliance on MGAs. And the logic of avoiding MGAs is clear: more control over risk selection and pricing, lower commissions, one of the main expenses for an insurer, a tighter feedback loop between underwriting and claims, and a clearer line of sight on the economics of each account. Why do you think the rest of the market hasn't followed suit in this regard?
I think one of the principal reasons is that the volume of transactions in an SME book of business are considerable. We had 1 million new business submissions in 2025. We sent out 750,000 new business quotes. We bound 100 or so thousand of those policies, another 100 or so thousand of renewals, tens of thousands of policy changes during the year, endorsements and cancellations, reinstatements. We probably had 10,000 claims. So there's a lot of work. And for some companies that are really behind in terms of technology, business process, and the like, they want to access the SME market because historically the margins, if you will, have been favorable, but they just can't get around they just don't have the systems and the infrastructure and the business process and the personnel to do it. So it's kind of a path of least resistance for a lot of companies. You appoint an MGA, you outsource the underwriting, and lo and behold, you've overcome your internal challenges. We just think it's not the best way to transact business. It creates a misalignment of interest, even though there's some really good MGAs out there.
Yeah.
There's some that are not so good. And paying an underwriter based on top line, it just creates a misalignment of interest. Some people are able to overcome that, but some companies are not.
Yeah. The MGAs, if I understand it correctly, optimize for volume because that's how they get paid rather than quality of risk. Is that fair?
Well, I mean, there are hundreds and hundreds and hundreds of MGAs, so it's tough to generalize. But I would just say, I would look at it. Yeah, more or less, I agree with that. The misalignment of interest can lead to bad behavior in some cases. But even beyond that, James, if you're opening a restaurant, what is your core competency? Well, we're preparing a meal, right? It's the cooking, it's the recipes, also the ambiance, perhaps, of the restaurant. But what's the core competency of an insurance company? Well, it's segmenting and pricing risk. It's underwriting.
Yeah.
Claim handling as well, right? That's an important part of the business. But why on earth are you outsourcing what you should be striving to improve all the time? You want to be the best in the business, and so it's not just the misalignment of interest. It just kind of undermines the value of the insurance company. Why would you invest in an insurance company that just had capital? Okay,
Yeah.
well, capital is worth the net asset value, right? If you have $1 million, it's worth $1 million. The value is what you do with that capital. Well, we're the best at underwriting and segmenting and pricing risk and providing customer service, or we have investment prowess and we can drive an exaggerated return with our investments, but here, when you're outsourcing your core competency, what's left?
That's fair. Yeah.
Anyway,
So
we're not
effectively,
believers in that model.
so what we're saying here is the people who rely on the MGAs are really exposing a gap in their own competence.
Yeah, look, I think
Or
it's
their own.
phenomenal. It's a great business for the MGA. It's a high margin business. It's a capital light business model. The market has driven the value of these MGAs higher and higher. I think, again, it's a phenomenal business for the MGA. I just wonder why so many insurance companies feel like, outsourcing a core competency is a great idea.
Yeah, no, that makes a lot of sense. But you do still use brokers, right? So I was looking before the call, and your broker concentration seems relatively high. If I've got this correct, your top 5 brokers collectively place more than 60% of your business, which means that if a major broker were to change its placement preferences, the impact on volumes could be significant. And I'm just wondering, how do you think about mitigating that risk?
Yeah, so we're sensitive to concentration risk. If you look at the compensation model within the brokerage firms, it's an eat what you kill commission model. And so really every broker, even though they may be employees of the firm, they have a lot of autonomy in terms of how they operate, if you will, their unique business, what markets they're going to send business to, what retail brokers they're going to market to, what industry segments they favor over another. And so in some ways, it's like the brokers are all independent contractors. And I think that mitigates the concentration risk a little bit, but we are sensitive to it. There has been an enormous amount of consolidation. There's also new firms opening up on a regular basis, and we routinely appoint newer brokers. Now, after a period of time, you might write $2.5 or $5 million with a premium with a newer broker. They're smaller businesses. They can't, match the volume we get out of larger nationwide firms. But you also have that's also a dynamic market. Marsh is leaning into wholesale brokerage now. The other big retailers have been doing that for years. I'm not sure about Aon and Willis, but and then we have some specialist retail brokers we trade with as well. If they can aggregate meaningful volume, they function, if you will, as a wholesaler. Mm-hmm. And so we're sensitive to it, but I wouldn't consider it an overwhelming concern at the moment.
Sure. And I guess we discussed earlier your tech advantage, the fact you're able to quote far more quickly than most of your competitors. I guess the brokers like that. That's an incentive for them to keep channeling business your way.
Yeah, look, I think we work harder for our brokers than any E&S market in the business, bar none. There's not a single company that matches Kinsale's service level to our brokers, our risk appetite. We're willing to consider some very challenging, distressed risks. And I think our brokers appreciate that. We do pay a modestly lower commission. That creates a headwind to growth, right? Brokers are comped based on the commission rate. So, that's an offset, if you will. But in general, I think, we need our brokers. Brokers need markets, right? That's their job, is to serve their customers and get the best mix of coverage and price.
Sure.
And of course, markets need the brokers. We distribute through the brokers. They're our sales force, where they're critical to our success. And that's why we work harder for them than anybody in the business. But I don't think anybody's going to walk away from anybody. There's no way Kinsale could ever walk away from a major broker. It's
It's a symbiotic relationship. You both depend on each other. That makes a lot of sense.
Yeah, we do. Yeah.
Okay. So kind of moving on, looking at kind of market share and growth opportunities. I think we discussed earlier that Kinsale holds roughly 1.5% of the E&S market, which is valued at about 140 billion. So you've got a huge growth runway ahead of you. So I'd like to kind of focus a little bit on that. So your model is characterized by a disciplined approach. Kinsale reviews a high volume of submissions, but writes a small percentage of those. Does that reflect a market full of unattractive risk, or untapped growth if you choose to lean in and had access to more capital?
Yeah, capital's not a restraint. I think it reflects a market that right now is quite competitive. There's been a huge growth in the amount of capital that's come into the P&C market over the last, 5 or 7 years.
Mm-hmm.
And the demand for insurance, it grows every year, but it grows incrementally with the economy. So, that abundance of capacity with a static, if you will, amount of demand means, hey, you got a lot of capital chasing the same number of buyers. And so there's downward pressure on pricing.
Yeah.
There's outward pressure, if you will, on coverage. Coverage becomes more expansive. Many companies compete based on commissions. So commission rates can be inflated in a market like this. Some companies compete on capacity. So you see companies offering much larger limits in order to secure business. And so, look, Kinsale, I think we averaged last year a 12.5% hit ratio on new business quotes, and we're fine with that. I think it reflects a competitive market, and I think it reflects a disciplined underwriter, where we're trying to maximize our terms and conditions at the same time as we're trying to provide a good service to the buyer.
Sure. So, you kind of touched on the fact that we're in kind of a soft market part of the cycle, and the insurance cycle is supply driven. Effectively, as more capital comes in, pricing squeezes margins. But the E&S market isn't monolithic. Instead, it's kind of a complex portfolio of micro niches, and each has its own cycle. So, you know, a hard market might persist in catastrophic exposed property, as we've seen kind of in California recently, or in cyber niches, for instance, and even as a soft phase takes hold in the casualty segment. And I noticed that the property has recently outgrown in your book over casualty. And I'm wondering if that's driven by these cyclical adjustments and how we should think about the composition changing going forward.
Yeah, look, the E&S market in the United States is roughly 1/3 property, 2/3 casualty. I think our book of business roughly matches that. There has been, over the last several years, an enormous growth in our property book, basically because there was such a distressed market. I mean, there was a bit of a crisis in the property market, specifically in the larger, as you say, cat-exposed accounts, particularly in the Southeast wind business and maybe to a lesser extent the wildfire-exposed California business.
Mm-hmm.
And as that crisis has dissipated, you know, accounts that we wrote at a very attractive terms, you know, those terms have become much more attractive to the buyer. And so in some cases, we've lost business. In some cases, we've just seen 20% rate declines. In some cases, we used to participate down low on a schedule. Maybe now we participate higher in the placement. So there's less risk, but less premium.
Mm-hmm.
But regardless, that crisis, if you will, in some of the cat exposed property accounts has dissipated. That market's dramatically more competitive.
Okay.
On the other hand, there are other property markets like inland marine, and we have a small business property team. We have a personal lines property book. So we have an agribusiness property book. So we have other areas where the property's growing at a double-digit rate. So it does reinforce your comment that the market's not monolithic. There's a lot of sub markets, and I would say property overall, if you had to characterize it, yeah, it's pretty competitive, but there are plenty of opportunity to grow in some of these submarkets. So
Okay.
I would think long term, the 1/3, 2/3 split, given that that's how the E&S market shakes out in the United States, that's probably as good a guide as any as to where we'll be in the future.
That makes a lot of sense. Okay, all right, let's move on from the cycle, the insurance market cycle. What I'm wondering is some kind of less well-managed insurers are willing to accept higher loss ratios because their investment gains offset the technical losses. So, you know, it becomes growth at any cost strategy. They kind of use their float to generate returns, and that compensates for lower margins on the insurance that they write. But, you know, other insurers, and I'm thinking about Ajit Jain and Warren Buffett, you know, Geico, they've used their float to generate excess returns for their shareholders. What I'm wondering is at Kinsale, how do you think about insurance float?
Well, we think about it in the traditional sense that it's a perpetual pool of capital that you know, it's other people's money. It's largely unpaid losses and unearned premium. But even for a boutique insurance company like Kinsale, it's in the billions of dollars. So it's an attractive opportunity to invest it, and you know, we get the return on that, and it's a nice complement to the underwriting profits we drive. I think most traditional insurance companies recognize the importance of making money on the risk trade. If you collect $1 in premium, you should pay out less than $1 in losses and expenses, hence your underwriting profit, and then you add to that, you know, your investment gains. And we invest our own capital, which is more or less around $2 billion, and then the float gets us up over $5 billion. So yeah, it's what makes it such an attractive business. But I do think it's important to recognize that you know, the float is a nice add-on to the underwriting profit. I don't think it's a substitute for it.
No, absolutely not. Yeah. Okay. Your combined ratio consistently sits in the kind of low to mid 70s, which is absolutely exceptional. And some insurers would trade some kind of that, so some of that margin for increased market share by reducing their prices. And again, I'm thinking about Geico. You know, their model was whenever their combined ratio tended towards the 90 mark, they would effectively cut their prices, and the combined ratio would then move up into the kind of low 90s, but they would gain market share in that way. Kinsale, I don't think, has chosen to do that, and I'm just wondering what your thinking is in that regard.
Yeah, I would say that we have chosen to do that, but we're in a very different market than Geico. If you think about the personal auto space, it's an enormous pool of risk because it's a required coverage to drive a car in the United States.
Mm-hmm.
So you've got in the hundreds of millions of policyholders, and they're typically buying basic limits. It varies state by state, but the basic limit requirement, to be honest, I don't even know what it is in Virginia, but it's peanuts, right? It's like $25,000 or something. And so if you have an enormous, you know, for Geico, it's tens of billions of dollars of premium, and your typical policy limit is, I don't know, $50,000 or $100,000. I mean, you have no volatility in that.
Yeah.
And you have a highly predictive predictable, reporting pattern and payout pattern. So there's a lot of precision in how they can price risk. As you come into the E&S space, our limits are larger. There's a lot more heterogeneity in the businesses we insure. The risk pools are much smaller. You still get a law of large numbers, but nowhere near as predictable. So there's that. And then I would say, we're in a little bit of a different market, but we do constantly adjust pricing. It's an enormous part of our responsibility, if you will, as managers of an insurance company. I think we do it very well, given the amount of data that we collect at the transaction level, the data that we purchase. We're constantly doing analytics to look for better ways to segment and price risk. And we always tell investors we basically price our business to a low 20s ROE or greater. But we are constantly adjusting pricing. The fact that our combines have been quite low, the fact that our ROEs sometimes drift well above the low 20s is a function of conservative reserving, where we see some of that redundancy come out. We do operate at a very significant cost advantage to our competitors. But it's always prudent to be cautious in the reserving. And anyway, low 20s ROE or better. That's kind of our goal. And then we'll see how things develop over time.
Okay. I mean, we touched earlier on kind of the soft market conditions and the fact a lot of capital has come into the market. And I'm wondering how we ought to think about pricing elasticity. Does more aggressive pricing strengthen competitive position, or does it simply just compress industry returns?
I think it's an elastic dynamic. The buyer wants low-cost insurance, unequivocally. Sometimes being more aggressive in price may not directly lead to increased volume, because sometimes you're quoting a minimum premium account where it's not really a function of the exposure times the rate. It's really, hey, you're willing to write that account for $3,500. Maybe there's other companies that say, hey, we need a $5,000 minimum premium. Sometimes it's capacity driven. In the property cat space now, you see a lot of companies offering up $25 and $50 million participation on a big property schedule. That's pretty attractive to the broker that's trying to fill up a $1 billion tower or a $2 billion tower or what have you. So sometimes it's not rate so much as it is, your capacity. We see companies now offering professional liability coverage with an occurrence coverage trigger. Occurrence policy never expires. We don't think that's disciplined underwriting, but someone else disagrees and thinks that's the proper way to underwrite that business. So almost regardless of how we price the risk, the buyer may favor the more expansive coverage grant. And so we lose that. So it's always more about just pricing, speed of response, especially in the SME market. A lot of times business owners, they don't buy an insurance policy until a vendor requires it. You're going to go on a job site and the general contractor says, well, James, I need to see proof of insurance. We don't have any, right? And you got a crew ready to go on the job and start working. So if we can respond in an hour, with a $5,000 policy premium, say, that's generally reasonable. Maybe somebody else would do it for $4,000, but they're going to take a week. You don't have a week, right? So anyway, there's a lot of nuance to it, but price is number one, unequivocally. Okay. That's why we're such zealots about trying to manage our costs as low as possible.
Very good. So your return on equity is kind of approaching the 30% level. And I'm wondering, how do you sustain that as the capital base in the E&S sector scales? Does growth eventually push you into larger, more competitive risks?
Well, I think we were in the high 20s for an ROE last year. And so I do think, as the denominator there, as your equity capital grows, that ROE can come down a little bit. It does bounce around a bit. Again, I would emphasize for investors kind of a low 20s ROE or better. That's what we typically have talked about in terms of how we're managing the business. But in terms of growth slowing in a competitive market, are we going to move upstream and write larger accounts? We do write larger accounts. We write them every month, sometimes in the 6 figures, sometimes in the 7 figures, but they tend to be more exceptional accounts. There's usually some degree of distress associated with the risk. There's been some losses. They've been non-renewed by somebody else. We're willing to step in and write high-risk accounts. So it's not a huge part of our business, but it is a part of our business. And I would say in a hard market or a more distressed market, we'll write a lot more larger account deals. In a more competitive market, we'll see fewer of those. So it kind of ebbs and flows. But there's nothing wrong with large accounts. It's just that they're subject to more competition than the smaller accounts. So that's why we really focus on kind of an SME type bread and butter account, because I think it's a little bit of a safe harbor, even in a competitive market.
Yeah. Okay. And your geographic exposure seems to be quite concentrated in states like California, Florida, Texas. Is that a function of opportunity or an area you're actively trying to diversify?
Well, we do write business in all 50 states, plus I think Puerto Rico and the U.S. Virgin Islands, but it's mostly concentration of population, right? Those are large populated states. They're also very litigious states.
Uh-huh.
So E&S and the trial lawyers kind of go hand in hand. We serve each other, if you will, right? The
Yeah.
trial lawyers are always stirring up strife and initiating litigation, and it makes it more challenging for a standard company to operate its business. And so, invariably, we're going to have more opportunity to grow in a state like Florida or Texas or California or New York or Louisiana than we will in some of your more genteel states.
Yeah. No, that's fair enough. Okay. All right, let's move on to kind of strategy and some of the critics. And what I mean by that is that Kinsale is kind of a recurring target of valuation-driven skepticism. And I know that the share price has recently come down and re-rated to the downside. So there perhaps there'll be less of that. But your multiples, I think, still sit well above your industry peers. And that gap tends to attract short sellers. And as of late March this year, short interest was close to about 10% of the float, with more than 10 days to cover. Now, I'd like to stress that, that there's no activist short campaign going on out there. Kinsale's widely regarded as a well-run business. But in terms of some of the criticisms, I'd just like to dig into to some of those and explore those in some greater detail. So, we've touched a little bit on the pricing cycle and the fact we're in a soft cycle at the moment. And I'm wondering how sensitive Kinsale is to those broader market conditions and how long you imagine those soft conditions are likely to persist, particularly now, given that more technology is coming into the E&S space. And so, rather than insurers relying on quarterly actuarial reports where, data trickles through more slowly, now I think the market responds more quickly, and the market, I suppose, can tighten very quickly as well. What are we looking at in terms of cycles, in your opinion?
Yeah, it's important to understand that in a rational market where we all looked at the risk and said, yes, the risk is worth X, and our expense ratio, let's just say we're 35 or 40% expense ratio on top of our expected loss ratio to pay claims, we would say, okay, well, we can't, we need to run an underwriting profit to get even a 10 or 15% ROE. And so we're going to price the risk accordingly.
Uh-huh.
And here's Kinsale with 15 percentage point cost advantage. So if we're all being rational and you're pricing something to say be a 90 combined ratio, well, hell, we can underwrite to an 85 combined and still be quite a bit cheaper for the business owner.
Right.
Right. It's inevitable. It's not an estimate. Hey, our costs are, in some cases 15 or 20 points lower than our competition in a commodity industry where the buyer cares a lot about price. Okay. And so we've got a lot of disciplined competitors, and I think we compete day in, day out. Now we view risks differently. There's judgment in the process. And so we win some deals, we lose others. But there's also a dynamic at this point in the insurance cycle where you've got people who are not rational actors. They're destroying their own capital. And if you doubt me, pull the Schedule P exhibit for a few of the larger fronting companies and look at their gross loss ratios.
Yeah.
Most of them, they're booking the current year at a 60, but if you look back 4, 5, 6, 7, 8 years, they're in the 90s. Well, if you're running a 90 with a 40% expense ratio, that's 130 combined. You think you're going to make that up with investments? No way. Okay, but the fronting company cedes most of that risk off to someone else, a reinsurer, of some sort. And so there's a lag. Does the risk bearer understand what's happening to his capital? Does he understand that he's being destroyed? If he were smart, he would.
Yeah.
But look, all I'm saying is you've got some very irrational behavior underway. And so if someone is mispricing risk, what can Kinsale do about it? Get out of their way and let them do it. And that's not unique to us. That's any good well-managed insurance company.
Absolutely.
That's why you've seen growth rates come down.
Yeah.
Who in his right mind is going to be growing an insurance company at 25 or 30 or 40% when you've got such aggressive behavior underway? Nobody.
Yeah. Yeah. But in the past, the typical insurance cycle would take about 10 years to play out. Is that fair? Are you seeing that now closing down because of technology?
I don't know. I mean, I go back to your earlier comment that you really don't have a monolithic market. You've got all these submarkets,
Yeah.
right? So the big wind accounts in the Southeast, big property accounts, they're coming down, rates dropping 20%. You go into the agribusiness property and rates are going up.
Hmm.
Commercial auto, rates are going up.
Right.
Um, Products liability, rates are coming down. I mean, it's all over the place. But if you look at it in the aggregate, I would say, hey, we're in a competitive cycle. Rates are drifting downward. Um,
Yeah, yeah. And a lot of that money that's flooded into the markets come from the private credit sector and the private equity sector. But we've noticed in recent weeks that some of these private credit funds have shuttered their funds. Their investors are looking to take money out. They've stopped that from happening. So there seems to be a credit squeeze going on. That's got to be positive for you guys, I'm guessing, because some of that credit and some of that capital that's flooded into the market is likely now to be withdrawn.
yeah, although I don't think there's a squeeze to the extent that private equity funds can't get deals done. I think private credit deals are still closing. Leverage is still coursing through the bloodstream of the economy. But I
Sure.
do agree if there were ever, a real retrenchment there, it probably would be a net positive for the PNC business.
You haven't seen any evidence
Anything
of that
that
so far.
restricts the flow of capital into the space would
Yeah,
be
yeah. Okay.
beneficial. Just like if you've got a bunch of bad actors destroying their own capital, well, that's one way to exit capital from the industry. Dividends, share buybacks, that's another way. Um, a
Yeah.
credit crisis, that could be helpful.
Fair enough. Fair enough. So Kinsale has explicitly stated that it aims to set reserves such that they are, and I kind of quote, more likely to develop favorably than adversely. And that comes from your kind of earnings numbers and earnings reports. And critics argue that the current earnings are flattered by conservative reserving assumptions that are subsequently recorded as favorable prior year developments. And Kinsale has reported favorable PYD every year since 2014. So, these critics will question whether Kinsale's exceptional profits are a result of genuine underwriting genius or an accounting tailwind from past conservatism that will eventually disappear as the market cycle softens. How do you respond to
Well, I'd first just acknowledge that we've never claimed any underwriting genius, okay?
that?
Underwriting is more about, looking at your book of business, disaggregating it by state, by territory, by account size, by class of business. We've done a tremendous amount of work to add other variables because there is data out there sometimes seemingly unrelated to the business that is predictive of loss, and we want to always refine and improve how we segment and price loss. I think we're really good at that. I think we're striving to get better. I kind of lost my train of thought. Well, the question was, yeah, the reserving. So
Reserves, yeah, PYDs.
yes. So again, going back to the point about personal auto versus E&S, right? It's a heterogeneous mix of business. We're putting up larger limits. Sometimes there's an element of unpredictability as to where those losses will eventually settle out at.
Mhm.
Even with the law of large numbers and lots of actuarial insight into predicting that, you don't know definitively. And so I think our legal obligation is to put forth our best estimate, tempered by conservatism. That's what we're doing. We review those assumptions every quarter. We adjust. Um, we're certainly not artificially inflating our results through conservative reserving. It would be the opposite.
Yeah,
It's really just a timing issue.
yeah,
Your current accident year is the most unpredictable. The further back in time you go, the greater the percentage that those claims have all been closed. And so the more time goes by, the more predictable the results are. And all your actuarial assumptions are based on that,
sure.
right? At the end of 2025, we had, and I don't even know the number, it varies by statutory line of business, but we had, let's call it 5 or 10% of our losses were reported. Well, the rest is incurred but not reported,
Hmm.
right? Each year you go back in time, that IBNR figure comes down and the reported figure goes up. Like they pass like ships in the night. And then
Sure. It
ultimately they're
rebalances.
all your claims are closed. Look, I think we're doing it the right way. I think
Yeah.
any well-managed insurance company tries to be a little bit cautious on the reserving
Hmm.
so that you're always having favorable development incrementally
Yeah, yeah.
as opposed to adverse development.
That's fair. No, I mean, just for the avoidance of doubt, this isn't an allegation I'm making of Kinsale. These are just some of the things that I've kind of heard in the market. So I wanted to give you an opportunity today to
Yeah,
address those.
if you're accusing us of being conservative in our loss reserving, we're pleading guilty.
Yeah, no, that's fair enough.
Guilty
Okay.
as charged.
So one of the other things that people will point the finger at Kinsale for is high employee turnover. So anecdotally, there's a claim floating around that your employee turnover runs at almost twice the industry average.
I
Um,
looked I looked it up
yeah.
in advance of this call. The last 12 months, it's 14.4%.
Okay.
I think the industry runs about 15.
Okay. So that's
Um, we divide turnover between what we call regretted and non-regretted.
Mhm.
And the regretted number, last 12 months is 9.1%.
Okay.
So, the 14.4 is slightly higher. It does kind of bounce around a little bit,
Yeah.
but I don't think there's anything alarming with that. And,
No. I mean,
we do strive to make this a great place for our employees to build their careers. I think we pay better than every insurance company in the Richmond market.
okay.
We're always focused on promoting from within if we can do it. We don't do it 100% of the time, but overwhelmingly we promote from within. We have an anti-nepotism policy, so we don't hire our close relatives. I would like to joke we love them, right? But
Yeah.
if you're trying to be a meritocracy and reward the doers, it gets a little bit ambiguous if my son is working here or your
Absolutely.
spouse or
Yeah.
that type of thing. So
Yeah.
I think this is a good environment. We do ask more of our employees. We're 5 days in the office. We have been since October of 2020.
Yeah.
We ask them to be as productive as possible. But hey, the consequence of that is we can pay a lot better than our competitors.
Very good. Okay, that answers that. Excellent. So there's a recurring industry critique regarding slower claims resolution and a deny and defend reputation at Kinsale. I'm just wondering, is your mid-70s combined ratio driven strictly by superior risk selection, or is it partly a result of aggressive legal stance on resolution?
Well, I would say, again, it's not quite that straightforward. You're aggressive or you're not. A third of our business is first-party business, mostly commercial, but some personal lines, homeowners coverage. And I think we generally jump on those claims immediately, especially in the personal line space, resolve them quickly. In the commercial line space, sometimes there can be ambiguity on a large layered placement. It just can take time if there's an industrial fire or whatever. But it's rare that there's actually litigation or any kind of aggressive behavior on the first party business. It does happen. I mean, we've had claims where we suspect arson. If a policyholder burns down his own building,
Yep.
and we can approve that, we're going to challenge it. But in general, I would say the first party business gets resolved quickly. That's the goal. On the third party business, it's a little different. We're in an adversarial legal system, right? We
Yeah.
inherited that from you guys. And so our goal is to defend our policyholder.
Yeah.
And, I think culturally what we strive to do is pay what we owe.
Yeah.
But that can be ambiguous. If you slip and fall on a grape at the supermarket and you say, hey, I've got a backache as a consequence and you need $500,000, and we're like, well, James, it was open and obvious condition and you should have watched where you're going. We don't think the supermarket's at fault. And by the way, even if they were, your claim's only worth $50,000.
Yeah.
Right? Okay, that's not bad behavior on Kinsale's part.
No.
That's just the way the legal system is designed. And we're in there negotiating on behalf of our customer to get the best settlement. We want to pay what we owe, but we don't want to pay extra. And it gets a little more challenging sometimes when you have more of a potentially severity-driven claim that may exceed the value of the policy. There can be demands by the plaintiff attorney, hey, give us your policy limit immediately, or you're going to expose your policyholder to a runaway verdict. That adds a lot of risk for the insurance company. The plaintiff attorneys use that as a tool, and a very effective one, to get a more generous settlement out of the insurance company and to get it more quickly. So that adds a complication. There's also a complication if we don't think there's coverage for a given claim. So we insured it was a drag race, a racing event. This is a number of years ago. And we offered coverage. It was a premises liability coverage for trips and falls in the parking lot and the premises. We were excluding any claims arising out of the racing event. And the premium was like $4,000. I mean, it was very modest.
Mhm.
And I think this was like a one-day racing event. So it was kind of a special event policy. Well, there was an auto accident that killed, I think 1 or 2 people were killed. And the policyholder says to Kinsale, hey, pay your $1 million limit. It's like, well, you didn't buy that coverage.
Yeah.
We're excluding the auto. We're just, for $4,000, we're just covering trips and falls in the parking lot.
Yeah.
Okay, so what should we do? Should we just pay the $1 million, even though they never paid us a premium for that risk? Well, no, we litigated that.
Yeah.
And we got the court to say, we agree with Kinsale. There's no coverage for that.
Yeah.
And we were dismissed from the case. I don't think that's aggressive claim handling.
No.
I think that's the business we've chosen, right? We sell coverage. It's not an all-encompassing policy. It covers certain perils.
Yep.
And, we try to do the right thing.
Yeah.
I
Listen,
would say
yeah.
we are probably more aggressive than our competition.
Okay. I mean, for me, it was a nonsensical kind of allegation because insurance is dependent on recurring premiums. You want whoever buys a premium from you this year to come back and buy insurance from you next year. And so treating the customer well has got to be front of mind all the time.
Yeah, I would say we see a regular and atrocious level of claim handling in our industry.
Mm-hmm.
It's an unrecognized weak point. If you want to know why the P&C industry overall is renowned for mediocrity, that's a big part of it.
Okay.
Companies that run bucket shops for claim departments, they pay what they don't owe. They have bad procedures in place to guide people's behavior. And I do think our claims operation is top notch, and it's a significant part of why we're able to post the results we are. A world-class claims operation combined with very disciplined underwriting, combined with very low cost.
Yeah.
But it's not nefarious behavior. It's prudent behavior. We pay what we owe. We're a high integrity company, but we're also in an adversarial legal system that requires us to push back on the trial lawyers from time to time.
Yeah, understandable. Perfect. Thank you for answering that. So let's move on. Very quickly, I've got a question for you about real estate. So, anecdotally, I hear that Kinsale plans to turn the former Anthem campus into a multi-phase mixed-use district called the Kinsale Center, with residential, hospitality, office space, retail components. So you're able to tell us a little bit more about this?
Yeah. So we developed an office building. I guess it was about 5 or 7 years ago, because the building we were leasing nearby was out of space, and there was really nothing available in this part of town. We're based in Richmond, Virginia, and so we developed a building, and fortunately, I guess we business was good, the company grew, and we filled the building up. So we needed to move on to a bigger space. We were able to buy the Anthem property, which was right across the street from our existing building. I forget exactly, but directionally we paid about $77 million for the 2 office buildings plus about 29 acres, mostly surface parking lots.
Okay.
And then we quickly resold one of the 2 office buildings that Anthem occupied to an investor for $63 million. So we got an empty office building and a lot of land for $14 million.
Wow.
Subsequently, we renovated that old office building and we moved our whole business into it. Our old headquarters, again, right across the street. We're about to sign a lease for a tenant to come in, and that building will be 90-some% leased, hopefully here in the next week or two. So that's going to be an attractive investment for us to just hold that building. That's our plan for the moment. We've got a nice headquarters building that we just moved into that we've gotten in at a really attractive price, even with a lot of dollars we put into the renovation. And so now we've got these surface parking lots that we're looking to develop into a mixed-use community. We're in Henrico County, Virginia. Henrico County wants this part of the city to be more dense urban development schemes. So there's some tax incentives to help us with the structured parking. And we'll have conversations going with prospective developers for an apartment development. We're doing the rough planning for another office building, a structured parking deck, and a hotel. And that's on the north side of the property. Once that comes together, we'll worry about the south side, which is really the more valuable real estate. But the net of it all is we want this to be an attractive place for our employees to work, have some hospitality, businesses nearby, hotel, et cetera. And it should be a nice moneymaker for the company as well.
So is the plan to be an insurance company with a real estate asset management arm, or will you ultimately look at spinning off the real estate and then being a pure play insurance company?
It could go either way, but keep in mind, insurance companies are in the investment business. It's just that most of our invested dollars are in AA minus, bonds.
Yeah.
And then we've got an equity portfolio that's a public equities that are about 12% of our cash and invested assets. And so the real estate is just a little add-on to that $5 billion or so portfolio. So, but it's an investment. And again, it's where our employees work. So we want this to be a good work environment. And it's an opportunity to make a buck at the same time.
Nice. So you're going down the Markle or the Fairfax route one day?
We're not really attracted to that investment model. We're mostly bonds and public equities.
Yeah, no, I'm putting
This is more about where our corporate headquarters is and making it a little bit more attractive work environment.
Okay, makes sense.
And an investment return, of course.
Okay, so I mean, looking ahead, how do you see Kinsale evolving over the next decade? And what can you tell us about your vision for where the company might be a decade from now in terms of market share and all the rest of it?
Yeah, look, it reminds me of the earlier conversation around valuation. When I look at Kinsale, I look at a company with a very disciplined underwriting operation. the market segment we're in, the control over the underwriting, the customer service model, the risk appetite, the constant work on data and analytics to get smarter about how you segment and price risk. They're, in my opinion, it's a durable competitive advantage. I don't think it would be easy for another company to just copy our model. I think it'd be quite challenging. In addition, our focus on technology and the expense advantage that flows in part from that is a gigantic advantage. And again, it would take years and years of effort and investment for someone else to catch up with where we are in our expense ratio, our tech stack. And so look, you've got a company with these durable competitive advantages that are very significant. Having a 10 or 15 or 20 percentage point expense advantage in a commodity business like insurance, it's hard to believe it exists, but it does. And so somebody quibbling around, we're in the mid-teens price to forward earnings. Should we be in the low teens? It's like, I don't think so, right? I think the stock's got a reasonable valuation to it. Maybe it should be higher, but we have the opportunity to generate best-in-class returns and incrementally take market share for years to come. I think that's a compelling investment thesis for someone who's managing money and looking to put capital to work. Yeah. Are you growing leaps and bounds? And did we grow leaps and bounds in the fourth quarter? No, we grew 1%. Our growth rate is variable. There will be times when it's 20, 30, 40%. There are going to be times when it's 1%. Yeah. And that's okay. And that's difficult for some investors to get a handle on. But if you look at a company like Progressive, who, in my opinion, is probably one of the most successful insurance companies of all in the last 30 or 40 years, their business model is just that. It's a highly efficient business and a highly quantitative approach to how they segment and price risk. And their growth rate has varied over the last 40 years. It's all over the place. It's not consistent year by year because they're dealing with the same cyclicality that the rest of us have to deal with. Yeah, but I think Kinsale's a winner. I think we got a great business model. We're a small company. We got a big runway. Yes, near term, we've got a competitive market to deal with. So what? We'll deal with that. We've been buying back stock. We'll do other things to make sure we're taking care of our investors and doing what we can to drive the stock price. Investors should be confident in our balance sheet, our reserving. The margins coming off our business are best in class. Yeah, the growth rate's going to vary a little bit. That doesn't disturb me, and I'm a significant investor in the company.
Yeah, you can say that again. Okay. All right. Just to kind of wrap up, I think we've covered most angles here. Is there one metric that investors consistently misinterpret when analyzing Kinsale? Or is there one aspect of the business that upsets you because you feel misunderstood?
The only thing I think I would add is, the culture of a business is critically important to how it performs over time. Jack Welch called it social software, but it's very influential in what, in our case, hundreds of employees, or in other businesses, maybe thousands or tens of thousands of employees are working toward. And I do think it's admittedly very difficult to quantify, but I would just tell you at Kinsale, I think we've got a very positive and consistent business culture. Our goal is to be the best in the business, the best E&S company in the business. We have a tremendous amount of stock ownership by our employees, especially people in leadership roles. And I think there's just a good alignment of interest there. People focusing on operating a high integrity company, working really hard to serve the customers, to drive value. And look, it's not a guarantee of a happy ending for sure, but I think it certainly increases the odds. And I think the whole agency principle problem in a capitalist economy is underappreciated. I think it's pervasive and it can lead to bad behavior sometimes. And I'm not saying it never exists at Kinsale, but we work really hard to always drive that alignment between the employees and the managers of the company and the owners of the company. And anyway, just one little plug for culture there.
Very good. Okay, I think that's probably a great place to leave it. So, Michael, thank you very much for your time. You've been kind.
All right, James.
We really hope that you enjoyed today's podcast, but we really only scratched the surface. If you want to explore any of the themes discussed in more detail, see the show notes or visit us at rockandturner.substack.com. Oh, one more thing. Be sure to like the episode, share it with others, and save it to your favorites so that you don't miss future episodes. Until next time, we wish you every success with your investments.